Hey, everybody, welcome to This Week in Pre-IPO Stocks podcast. With me, I got Nick Fusco, CEO of 8View. It's a pre-IPO secondary market pricing company, and Evan Cohen, co-founder and chief operating officer of WithVincent.com, a media company focused on alternative investments. All right, fellas, I told you photorealistic avatars were coming, and here they are, right? So TikTok just announced avatars for their creators. I actually think they just pulled it because somebody did something not nice, but avatars for creators. So they're out there now, photorealistic avatars. You can send in your likeness to TikTok. They will make an avatar, and then you can put in different languages, read different scripts, the whole thing. HeyGen is another company. They just raised at a $500 million valuation. This company's like that last mile that we've been talking about the last couple of weeks on top of AI. So they sit on top of OpenAI and this company called ElevenLabs, right? And they have a $500 million valuation. They're doing $35 million in ARR. They have 40,000 customers. They're profitable already. That's like a real business, right? And then lastly, I just used ElevenLabs. I know we were talking about it before I hit the go button here, but I used ElevenLabs to publish my weekly market update in Mandarin and Spanish. So I'm here to tell you, if you're a Spanish speaker or you speak Mandarin, to check that out. Right, but also
it in the comments down below.
It works, man. So
have you audited it though? Have you made sure that what they're saying is actually translation? They're not saying like, hey, by the way, you can buy SpaceX shares for
very smart
$3.
Because you're very smart, because I don't speak Mandarin or Spanish, right? So I just like popped the video in there. It's actually kind of cool. Like, not that I don't know if you guys care, but I'll just give you like 30 seconds. You give them a YouTube URL. You hit the language you want it, from to, right? You hit the button, and like, I'm not kidding, 30 seconds later, you download the video, and it's your voice. It's your voice inflections, which blew my mind, right? In the other language. And it's dubbed. So it doesn't do the mouth. It doesn't your mouth doesn't like magically speak Mandarin, right? But your mouth speaking in English, but it's the voice, the sound, the audio is in a different language. So really cool, like really, really cool, I think. But to your question, Evan, I sent it to my boys over at Crane Shares ETFs, right? And they said that it was accurate. They actually thought it was me speaking. Okay. And they were like, we didn't know you spoke Mandarin, Aaron. They're like, you have very good accent and you're very good Chinese accent. And I was like, that's not me, fellas. That's the AI. Right? I think it passed the sniff test, right?
Oh, man.
Anyway, enough of me talking about this. What do you guys think? So here's photorealistic avatars like hitting home, right? Of course, it was driven. It's AI driven, right? It's not just, kind of like through the headset. Now we're kind of seeing it through these applications. But what are your thoughts? Are we going to see more of these photorealistic avatars? Like, Nick, maybe we'll start like more photorealistic avatars, more companies like HeyGen, right, that are kind of focusing on this space and bringing it through the last mile. Like, what's your gut telling you?
My gut is you might have to have a resurgence of it, right? Because we actually saw a lot of it a year ago. Everybody came out on Twitter and they all had their own avatar set up,
right?
And it was very much a 2D, just artist take on you. So I don't know if that's going to come back like thick and fast, but it does make a lot of sense for some of the things that we're discussing here that could be transitioned to how do I make the multiplicity effect, if we remember that movie for the audience, right? How do we make many of me so that each one of them could keep doing what we're doing? Because naturally, I mean, we're all, let's say in this case, founders, right? We want to project what we're doing with our business multiple times over, because that the fifth person or the 50th person of our company won't be able to do quite the same or have the same impact. So maybe this is a pretty cool way to do it. But yeah, I don't think it'll be thick and fast, but I think it will be more widely adopted than it originally was a year ago, which was seemingly fad based when all the reporters had it.
Right. I mean, Evan, would you like do a photorealistic avatar, like send your likeness in and have them make one for it? Like, what do you think?
I don't have an issue with it for the most part. I have my own personal reservations and fears around deepfakes, like digital security. So I do keep my personal likeness to the best I can.
Sure.
to myself, and I try not to upload as much information about myself so that there would be 3D renderings of me or deepfakes, etc.
Right.
But I do think that if there was an application in which it could be used for example, like a video conferencing service or some sort of digital like second life experience where having a photorealistic avatar of myself would be beneficial to me, yeah, I'd be super interested. Like gaming, I think
Right.
gaming is while it has grown a lot as a market and in terms of dollars in over the last few years, I still feel like it's a recession-proof industry. People will continue to pay. It continues to grow. It continues to compound. And
Right.
as we see hardware advances, specifically in virtual reality and headsets and software advances and GPU advancements, like it just all leads toward, I hate to use the word metaverse, but like it all leads toward that like sort of metaverse reality, virtual reality, and having a photorealistic avatar seems like a reasonable thing to have. Now, will this
Yeah.
company be the company that does it? I don't know. I imagine Meta and Apple are also going to create
Yeah,
those.
Oh, for
So,
sure.
we saw the three of us definitely saw the Lex Friedman interview, right, where they went in and just kept
yeah.
switching between their avatars, right? So
Right.
Mark Zuckerberg's was really quite good, and Lex Friedman's was kind of on par. Why not? I mean, this is quite brilliant, and I think I mean when you bring it to the next level, it's going to be that Hollywood level that everyone's concerned about, right? So now we can start bringing back actors from the dead. We can stop paying new actors quite as much money because people want to keep seeing Clint Eastwood in his prime. You know,
Right.
maybe that's a weird one, but it will definitely change kind of the arc and how just the economics of that might work in Hollywood for royalties, because you're going to bang out royalties before you die, and then your likeness could be used for the next century.
Yeah.
Um,
But can we agree though? Not that I want to like go down the rabbit hole on entertainment, but like actors, that's like not a thing anymore.
doesn't
Like
need to
Well,
be.
if you're a kid growing up, like, I mean, you could act. I think there's always going to be like, New York City, right? There's always going to be a Broadway and like live, like live in person theater. But I mean, to your point, Nick, like, you're going to be able to swap out actors for leading roles in a movie because you want to see that person instead of. I like Sean Connery as 007 instead of these other guys. So like I want Sean Connery forever in that new 007 movie that's going to come
Right.
out. Like, I mean,
Even
right?
even if we don't get to that quite extreme, you can screen test one actor against another now. So maybe
Definitely.
we're not going to produce the movie, but we'll screen test it and present it to a crowd to see what they think about
Yeah.
the dynamics between two characters.
I don't think it's
So
bad. But look, I just think you're going to have more directors. You'll have more content. You'll have more people to be able to get their stories out, right? With really
maybe
high
that is bad.
quality.
How much time do you guys spend on Netflix just
Oh my gosh.
watching previews and never getting to it because the content is so bad now?
Oh,
Right?
my wife hates it.
So
She
bad.
like I doom
So maybe it
scroll.
is bad.
Yeah.
I'm like rewatching Entourage right now, and I'm sort of seeing that exact, like there's all these scenes where like Vince and the director are sitting on one side and there's the studio on the other side being like, well, yeah, like we should do it in color because like the audience tested positively, but you lose like the artistic element. I think there was a quote that I said in the episode yesterday. It's like, it's not an art house movie unless the majority of people dislike the movie. And I'm like, maybe that's like a good
But it's like a niche, right? I got to tell you, like this is why I watch like unbelievable amounts of YouTube, like on the TV, right? Because I watch like I'm like a nerd. I like watch financial services content like constantly, right? And like you find these like people and they like have this video or this series that they run, and I watch it all the time, and I don't think anyone really cares except for, like, to your point, Evan, like a small little portion of the population that like really nerds out on like that particular type of content, right? But that's where I think that's where we're heading, right?
Maybe this is one of the hardest things. So, Aaron, you put out a profound amount of content for one person. It's always really, really impressive. Now, let's say that you had a copywriter that could write that for you, and then your avatar would read it off for you. I think that will take another decade to get there, because who knows what your facial expression is going to be for any point in time in the sentence, or exactly how it's going to get read off. That will be really, really hard. Easier for someone to read, but for it to match how you go about it, or even the hand gesture, right? That will be very, very difficult. So maybe the multiplicity of that might be very hard. But yeah, the recreation of content or just serving up what you want to see, that's already happening, right? It keeps feeding you like people of who you just watched or like topics. Yeah,
that is true.
Well,
That is true.
what
What do you got?
what do you think will be disrupted first though? Video content or audio content? For like music, for example, which is so much more anonymous genre to an extent.
Right.
Like how often are you listening to a song where you like the music and you have no idea who the artist is?
Fair.
Like that just feels like a much more like, oh, we can just take all that music and data and all the information about the music content and just pump out similar content all day. I mean, Spotify is already using your music tastes to curate music that you like. It seems like just the natural next step versus, I feel like in film, there is still an element of like, I want to see Sean Connery. I want to see a horror film. Like you have to cross the chasm of like recognizability versus in music. It's much more anonymous. And I just feel like that's the first step. If you're a musician, like you should be concerned.
I would say, like I think there's a lot of truth to that. But I would offer this though too, Evan. Like I wouldn't be opposed to watching, to Nick's like doom scrolling comment. Like I wouldn't be if I like was scrolling through HBO Max or Netflix or whatever, and I saw something like, oh, that looks interesting. I'd like clicked on the button and watched it, and I couldn't tell that was like AI generated. I mean, I would. Not to say that, so maybe to your point, I don't think I would 100% of my consumption would be like that, right? But I could see 10%, 20%, 25% of my consumption would be like stuff that's like more dialed into what I like,
So let's take that to one more level. You guys remember, I don't know, 10, 20 years, a lot of films used to end with the credits and then they'd have an alternative ending or something like that.
Yes.
Yeah. What if Evan liked things that were a happy ending and Aaron liked things that were more of a mystery or like left you hanging, right?
Nick,
and then you both ended up watching a different movie,
Yes.
Choose your own adventure.
I kind of like that. But then you guys hop on this podcast. You're like, did you see that last night? You're like, yeah.
But I
can't believe she died in the end.
But there's something to that though, Nick. There's less that like shared human experience kind of goes away, right?
Right.
Because you like didn't see the same thing. Like everyone's like, what's going on right now? It's like House of the Dragons is like the second or third episode, right? So like people talk about it, like you listen to people. Oh, did you watch it? Oh, this is what did you think? How's it going? Do you like the second season better? Like this and that. There's like a discussion about it. If everyone's kind of watching their own version of it, that kind of goes away, right? To a certain degree. Or if there's like the director's cut. I mean, that's the other thing I think could probably happen, right? You know what I'm saying, Nick? Like,
right.
Oh, you got you got Evan's cut of it. You got Aaron's cut of it. You got Nick's cut of it. And it's like, which one did you like better? Or which one did you watch? Like I could see people doing stuff like that. You know what I mean?
Absolutely. I think that seems like one segment of where the market will go. I think that what we should do, like just thinking about this for a second, taking even a further level, Nick, is like, let's talk about the business models for this for a second. Where does this actually go from a monetization perspective? Because at the end of the day, like, remember HBO made its brand and its money on being premium content and being the people that were the auteurs, the people that created the highest quality content. And you went to them because of what they created. And then you see like the Netflixification of the entire industry where people are going to, it's just about having lots of content and things for you and predicted algorithms that are telling you what you like. But at the same, like if we take AI and we figure out a way to drop the cogs on creating all of this content where it's much cheaper and inexpensive and people can choose their own adventure, it becomes a much more competitive marketplace, right? Now suddenly you can have an upstart that competes with Netflix or HBO because the IP is much cheaper, the YouTube, etc.
Yeah.
And then does the business become entirely commoditized? And then does it revert to the curators and the auteurs, which is like at the end of the day, okay, I could have the thing that everybody has, like ChatGPT.
Listen, Evan, what you're saying though is kind of like what's happening now. Like we had cable and we had these like premium channels, and then YouTube shows up and it kind of democratized, like anybody could upload something, and then we have it on our TV, and then now it's all streaming, right? And that was kind of like the great unbundling. But it's funny, like humans, I don't know if it's consumer behavior or just the way we are, like everything's kind of like rebundling back again. I don't know if you noticed that, right?
No,
but it's all like rebundling back again, right?
But those business models are very tried though. Like that's the problem, is that the reason why they bundle is because
that's true.
At the end of the day, like the models are just crumbling from subscription to advertising. Look at Netflix.
True.
All of them are adding advertising layers because they're trying to make more
Fair point.
money. They all burned a ton of cash to get to the positions that they're at today. And so it makes me just genuinely concerned about the long-term viability of the media landscape, because, you know, I have, like, if you have an actor like Tom Cruise who's demanding a certain salary and suddenly there isn't a market for that, like, it just creates a commoditization of something that was very much culturally driven. And I wonder how that impacts our society. And does it become like Mr. Beast becomes the next Tom Cruise because, like, he's an influencer?
It's you're not wrong. You're not wrong. Well, look, so just to wrap up this, because I know I want to hit on the other two topics too, fellas. But the last thing I just say, this HeyGen thing, I think is super interesting, right? Because it's sitting on top of OpenAI and ElevenLabs, which are two like AI large language model type offerings. And we've been talking the last couple of weeks, like, we think there's going to be, well, I do at least think there's going to be more companies like this. So here's a company that's sitting on top of what I call two AI platforms, OpenAI and ElevenLabs. And that company has a $500 million valuation, and it's very profitable, right? And I'm like locked in with these guys now. So I'm going to start publishing, like, they're $24 a month. I'm probably into them for $100 a month, easy at this point, right? And that's in like perpetuity. That's a good business.
That margin that they have will be eaten away by competition, right? Like, it can't stay like that forever.
Well, I mean, look, I use Buzzsprout to publish the podcast, right? I mean, there's like other people that compete with Buzzsprout. I pay them, I think, $20 a month to do that. You know what I mean? So I don't disagree with you that the price could come down. That I don't disagree with, right? Because there'll be more competition and I can pick or choose. But I do think that's an interesting business. And I can't imagine, I have to imagine they're making crazy margins. If they're profitable and they've only been out for a year and they got 40,000 customers, they're probably making 60, 70% margins or something crazy like that, right? You know, on that.
If they're able to do it that quickly, that turnaround, you're probably right. I mean, if the compute on this was outrageous, you got to start to wonder what their cost would be.
Right.
But yeah, I mean, that would be a nice barrier to entry. To argue the other side of Evan's point, you know, if the margins are not outrageous, new entrants would come eventually, get chewed out because the cost is too high, and compute cost doesn't seem to be going down necessarily, right? So yeah, I wonder. But what's that? A 30x revenue multiple roughly? Like, where are they at?
Yeah.
Okay.
Yeah, I mean, they're doing 35 million ARR. So what is that? If you want to do 3,500 into 35, what's that at?
Would love
if
to
you
know
do ARR, right? That's 14.
Of that. I would love to know what the dispersion of that audience is, of their customer base, of it versus enterprise versus consumer versus prosumer.
Right.
Because it's a lot of revenue to be made if it's a direct consumer play.
Yeah,
that's just a lot. It's small dollars, adds up.
Yeah,
it's really much more impressive than a couple of big enterprise clients carrying the load.
Yeah, there's businesses here. That's all. Like, like if you're an enterprise, you could probably just do it directly with OpenAI, right? Mm-hmm. Like, why do you need an ElevenLabs or a HeyGen, right? But like, I'm not gonna write code or hire a developer to do this. I'll pay HeyGen to do it. You know what I mean? Like,
yeah, and I think for this, if the cost is low enough, it's sub $100 for a business.
Yeah,
you're going to be sticky, right? There's a customer lifetime value there that's going to be pretty sticky,
right?
I don't see any of us willing to save $3 a month, or even $10 a month just to flip between services. We already have enough passwords out there, right?
You got that right.
Yeah,
you sure do. Okay, all right. So let's talk. So we got some more market dislocation here, right? Second topic, more market dislocation. So Revolut came out last week. They're going to raise at $40 billion valuation. Okay, they're at the secondary market right now. My math has them at 23 billion. That's a 75% jump from the secondary. So that's a huge swing, right? And this kind of, if you recall a couple of weeks ago, so we talked about like ScaleAI did a round, right? They were up. So they were at $13.8 billion valuation. The secondaries were at 7.4 when they announced that round. So that's a huge jump too, right? And then we had two other ones that came around the same time. Anduril came out at a $12.5 billion valuation for a primary round. They were at 13.2. So that was down, right? And then Groq came out at a $3 billion valuation, and they were at 4.4 billion in the secondary market, right? So like dislocation. So like, here's my thing. Like, so maybe Nick, we can start like, Nick, like, what do you think's going on here? Like, why why is the secondary market getting it so wrong one way or the other? Is it just lack of information? Is it just like distance between the primary rounds? Like what do you think? Like, what do you think? What's up?
Sure. I mean, the most of the companies you just mentioned are really not mature, like super mature companies, right? So when you're looking at a Groq or maybe an Anduril is relatively mature because they've got their slope of growth and things of that nature. ScaleAI, no one really knows what to make of that over if you were projecting it out another 5 years. But
Sure.
Revolut, I mean, that's bold in my opinion. You've got a lot that's been tried and tested from other banks or processing or payments companies, whether public or private. So I think putting a big number on there that's aspirational is not
Yeah.
quite the same as a Groq or an Anduril doing the same.
Right.
So yeah, I think that the secondary market in this case is probably closer to accurate of what the real value is than where that round really wants to be. I mean, you've even seen this. Remember the Lego round with Epic Games?
Right. Yeah.
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 I mean that was
That was a big
pretty
pop.
far off.
Yeah.
So
Way
so
far.
so I just think it's really interesting. But I don't think for I don't want to call Revolut a legacy business, but a business that's relatively well understood, has been around for a long time. I just think that's a little too aggressive.
Okay, so maybe now I'm kind of in the same camp. Like this is, they obviously announced that this is the target valuation, but like to be determined if they actually hit it, right? So like, I mean, Evan, what are your thoughts here on Revolut, right? I know you obviously dabble in the fintech space, right?
Yeah, quite deep in the fintech space. And I mean, I have a lot of reservations around this one. Particularly, I mean, there's a pretty good comp out at Nubank, which I think that their valuation is closer to 50, maybe like 55.
Right, right,
And they've got, I think, 3 times as many customers. And
yeah,
so,
yeah.
and we've talked about Revolut on the show before, so I think my feelings are pretty well known. But I agree that at the end of the day, this is just an announcement. This is not a closing, right? At the end of the day, money trading hands, closing of deal, wired funds, like that's really where the price is actually determined. We have seen, like the first company I thought about when I heard the news, or when you shared this with was Epic Games, which is like you're seeing almost 100% jump from the secondary
Right,
markets, which just seems very, very aggressive, especially when fintech valuations and specifically neobank value, like that whole market is very tumultuous at the moment.
right.
So I think 40, if there are investors that want to pay that clearing price, Morgan Stanley's out there, shilling it. That's a whole different story. But
Yeah,
I think it's definitely overinflated, at least from what I would expect Revolut to come
right,
out as. And so what it shows is that we're now getting to the stage where there's been enough of these tender offers where companies might start to be pushing the bar too far, right? We saw Stripe do it, we saw SpaceX do it, Anduril, all these companies are trying to do these tender offers instead of trying to stay private longer. And I think this is just an example of a company which just probably their ego got ahead of them, and they're like, look, if we can do it, we'll do it, and
yeah,
it's no skin off our back, right?
yeah. Well, I'm rooting for him. I mean, I have, like, I published this weekly report, right, on valuations of pre-IPO stock. I mean, I haven't bumped them up yet to 40 because that just seems, it seems like a lot, right? So like, I'm cautiously I'm like, I really do. I want them to hit it. I think it'd be awesome for the employees and the company and investors and all of that, right? I just like, man, that's a lot. It's a big jump, So like, until it's booked, I don't know if I'm going to be updating it in my reports and everything, right?
Didn't Wise recently go public too, right? They just listed, and I thought the stock was not doing so hot.
No, that I'd have to check out. We can come back to
Okay.
that next week, man. I'm not sure.
Okay.
I'm not sure. But okay, but on your point, Evan, on tenders, right? So this is the last thing I wanted to talk to you about. So like are tender offers good for companies and good for investors, right? So I just want to have a quick discussion on this. So like Stripe came out, John Carlson did an interview with David Rubenstein, right, who has a show on Bloomberg. And in the interview, he said that Stripe's going to continue to do these tender offers, which to me, obviously, like Stripe's one of the largest pre-IPO stocks. He made it sound like they had like no intention of going public anytime soon, right? Like more, he was like, quote, quote, more tenders, will do more of these in the future. Right. So like, are these things good? Right. Um, like, what are your thoughts? Like, maybe Evan, we'll just start real quick with you. Like, what do you think? Is it good? Are tender offers good for companies, and are they good for investors?
I think that they are good for companies. I'm a fan of the concept of allowing early employees, uh, early executives, even early investors to get some liquidity on a company that has been private for a long time. I believe that there are certain companies that, you know, being public is just a burden of effort and expense that might not be necessary. And if you have the market and you can make the market and there's enough demand, I think it's a perfectly good thing for them. I think Stripe is a great example of that. I think SpaceX is a great example of that as well. There's no reason for them to stop. I do believe that not every company should do it, A. And B, I believe that if this continues to go on, we will start to see some regulatory scrutiny because there are limits to A, the number of investors that are supposed to be holding a private company. And at some point, there's like they say, hey, after a certain number of investors, you are supposed to go public. I think
Right.
that if these tender offers keep happening and we start seeing more and more investors through SPVs and layered SPVs get involved, I could see regulators saying, hey, look, this SPV private infrastructure is a little bit dangerous. It's kind of going beyond what we expected. We might need some more regulatory clarity here. We might force some companies to do some things to make these things more compliant. And that could
Right.
be burdensome. So I do think investors should have a little bit of caution by saying, hey, look, like we're entering somewhat uncharted territory here on $200 billion private companies. It's a lot of money for a private company.
Yeah.
And so I wouldn't be surprised to start seeing some scrutiny on the regulatory side to figuring out how this thing should be managed moving forward.
Okay. All right, Nick, what do you think? Like, good for companies, good for investors?
I think it's generally a healthy sign if the company is able to facilitate a number of tenders over a year or a course of 5 years. And to be fair, the company probably has more flexibility than you'd want to think about how much they want to throttle the tender, how much they want to control the price of the tender. They have a lot more ability to do that than they do controlling the price they get served up by an investor in a round as well. So once they get to a certain point where they're not commanding or needing so much external capital, you can do a combo of do a raise and do the tender at the same rate, or let's just not take in any new money. And if we want to do something really big to satiate the request for liquidity, we do it. If we want to throttle it a little bit because we're concerned about our numbers, we're concerned about internal employees freaking out and running for the doors, they can also reduce it so everyone gets a pro rata share of what they actually want to sell.
Right.
So I think there's probably more control, and you even see that with the Tesla, not Tesla, the other company that Elon has, right? With SpaceX, it's a very clear step function of where they're heading with their tenders. And honestly, I've put this opinion out before. I think those tender prices are probably low relative to where the market would really price that stock. So
Right.
yeah, I think it's healthy. I think it also is good for employee retention because they know, I don't have to wait around to the IPO. If you're scratching your head and saying the IPO might be 5 years from now, do you really care anymore? Because now
Right.
you can facilitate that liquidity to do what you need to do to upsize your home, or kind of you have a new child, and you need to take care of school or those costs. The
Right.
money is there, not just paper money.
So I got to tell you, I've gotten friendly with these guys at a firm in Paris, pre-IPO kind of brokerage firm called Not So Liquid, right? They're actually
Love the name.
two really, really cool guys, right? And so they had some interesting thoughts on tenders. They were like, look, you should do a tender, but you should also have like a structure to it, right? So like do it every 6 months, do it every year, and be like vocal about it. Where, I think to both of your guys' points, like employees, everybody knows, investors, like there's these opportunities for liquidity and they're coming, right? So if you're not going to do it this year, you can do it next year. You can sell, you can, to your point, Nick, you can manage it. So I can sell 10% of my position now. I'll sell 10% because that's what the company is going to allow me to do, but I'll be able to continue to like dollar cost out of my position or whatever, right? You can kind of manage to that then. They also had some interesting dynamics, because they talked a lot about once you go public, if you have all this pent up sell demand, right?
Right.
If you go public and then you're out of the blackout window, all these institutions are going to go out and sell then, right? Which puts massive downward pressure on your stock in the public market. So they're like, if you have these kind of like orderly tender processes, you're able to like have a more natural balanced state for the price of your stock, which could be good or bad, right? You know, depending on how you raised capital and what valuations you raised at, right, over time. But, you know, you have this kind of more natural state for your stock once it hits the public market, you know, where the thing potentially would price. You won't have these kind of massive swings in stock price after the blackout period.
That's exactly.
I just want to hit on one weird one and then grab it, Evan. But even things like 83B elections, where your 409A valuation is substantially lower than actually where the tender might end up occurring.
Can you explain what those are? Because I know most people are not going to know what those two things are. Explain both those.
So 83B election is effectively when you have options and you buy them out, you have to compare them to the fair market value, which ultimately, if it's a public stock, would be whatever your price you're gonna get paid for it. But for a private stock, due to the illiquidity, it's oftentimes substantially lower than even where your strike is, or very close. So the income tax would actually have to be paid for any in the money kind of variance between the option and that valuation. But if you're really out the money when you purchase it, that's great. You're not going to have to pay income tax. And then you'd only pay capital gains on the difference between the option and where your sale price is. So that might be, let's say, that tender price in this case. Right. So really, you can't play that game as an employee of a firm if you're in the public market, right? Or if you don't have a decent difference between, let's say, where the tender and the 409A would be. So that's a huge value add for employees. It's just massive tax difference, let alone things like qualified small business stock and other things that you can do as a private company that benefit.
So bring it back to the tender piece, right? Because I cut you off there to explain those two items.
Oh, I just see it as a profound benefit for the employees. You know, that's not going to be possible for them to capitalize on the same way once it's a public stock. And it's also, it wears on you when you're working for a public company and you see the share price swinging up and down by, let's say, 10% in a month, right? So
it's true. Yeah. Go ahead, Evan. Go ahead.
Yeah. So all these things, like going back to, and I hate to be the negative Evan on this one, but just the thing that you hit on, Nick, the thing you hit on, Aaron, that I want to reiterate here is like, as you have these tender offers, what you do end up having is somewhat a wall of liquidity interest. And if you don't have a structure, what will end up happening, and what I fear the biggest challenge and where regulators will come into this, is that you'll see basically retail investors will never get access to the massive growth potential of a lot of these private companies, especially as they stay long. And what will end up happening is when they do go public, investors will want to buy SpaceX and they will be holding the bag while institutional investors liquidate. And what I fear will happen if we don't have structure into this industry is that, one, retail investors will be shut out from the massive opportunity to generate wealth off of companies that they may be customers of, that are in markets that they're paid taxes for, et cetera. Like, so they missed out that whole thing. And it lives in the private markets where all the people that are allowed to play in that market get the benefit. And then when they are allowed to participate, they just get crushed by the liquidity wall. Yes. So that's where I feel like regulators are going to sit there and say, well, we got to figure out something here, because when SpaceX goes public, this is going to happen. Like there's going to be a lot of people that have been holding these shares. They're going to want to liquidate. There's going to be a lot of.
Yeah.
Definitely.
Yep. No, everybody loves SpaceX. That's like America's. I'm like convinced that's like America's company. It's like we all grew up like, well, at least it was in the 80s, and you like would watch the rockets go up, and it was like you stopped school and everything. It was like iconic, right? So this is like I think people in their 30s, 40s, and 50s still remember that. You know what I mean? It's like so cool. It's such a cool company. But okay, the last thing I wanted to hit on with you guys on as it relates to tenders is there's this like stigma. I still think there's a stigma with VCs and executives at companies, right? That if investors come in and then they sell in the secondary market, so before an IPO or before an acquisition, that's like a bad thing, right? Like they didn't stick it out all the way through to the liquidity event, right? They kind of got out early. And I guess my question is these tenders, I think these tenders, some of these tenders are happening because these guys have been private for so long that the investors have to give DPI back. Like they got to
Right.
distribute back to their investors, right? So like, do you guys think that this is like changing now? Like because companies are staying so private for longer, like the stigma of like being invested for the duration with the company is changing. Like founders are getting comfortable. Like, okay, these guys invested in our, Series A round, and now they're going to be fully out before an IPO happens.
Yeah,
Or
here's
what
where
do we
we
think?
miss Clint. Clint's going to be all about this. It's definitely about duration. It's definitely about how much distributed capital is going to go back to the investor. It's important. So I don't think it's a matter of a binary event getting all the way to that IPO and then releasing. I mean, the LPs are really having more of a voice today than ever, I feel, because you go into a fund with these certain expectations of duration, and then they're not hitting. So if we could
Right.
still receive largely some of the returns that were expected, but we're getting closer to the duration that we signed up for as investors, let's say, I think that's that shouldn't be frowned upon or poo-pooed, right?
Yeah. I mean, that's I hope the stigma kind of comes off because I actually think it's healthy for a market to have people come in and out. Like I understand if you're a founder too, like you definitely don't want people like buying today and selling 6 months from now, right? Like that's probably not what you want at all. But if someone comes in and they invest and then they hold for 5 years, you know, or maybe 7 years or something, right? Like some like thoughtful amount of time. And then they decide like, hey, for whatever reason they need to sell. I think that makes sense. The other thing too, Nick, is I think as more market participants come in, so obviously when it's all like venture capital firms, I think that's a much different investment horizon for a venture capital firm, right? But if you start to get like, more like individual people, right? Or like I'll call it more wealth management focused LPs, like what I have.
Right.
That like I got to tell you, man, like you really need to just acknowledge the fact that these are individual like people, and they like die. Okay, so their
Yeah.
estate come in and they might want to do something different. Their cost basis steps up. They just want liquidity, like whatever. Like there's or um their business their business goes bankrupt and they need cash, or or they get a divorce, right? And they got to split everything in half. Like things happen, for certain segments of the population that doesn't happen to pension endowments and foundations,
Right. And
right?
that
So
almost harkens back to one thing that Evan brought up. So as regulation really comes in here, one thing that was slated was for the private fund advisors rule, that what you've described as an LP stake getting transferred because of death, because of divorce, because of any of the D's out there, that you're meant to be getting an external value or to look after what the valuation of that exchange is meant
right,
to be, right? So
right,
that's important. But that's a really hard thing to clear. It's not like you have a 2020 Honda Civic and everybody knows the price because of the number of miles on it. It is looking at the individual investments, looking at the time horizon until this thing may eventually be paid back, understanding who the manager is, what vintage
right.
it is, all of it. That's
Yeah,
really hard to price, right? So I think that we just need more participants here, and we need folks to really get to the bottom of valuation. That's part of what we solve at 8View, right? We want to be able to value the individual assets and invariably total funds and
right,
performance there. But it is a hard task to approach objectively, and the more liquidity that you can satiate there, really the tighter those spreads are going to be. So no one's really getting their face ripped off on either side in those cases, or hopefully as much down the road.
right, right. Okay, so it sounds like net we like tenders, right? And that this is I think a good thing for the kind of investment ecosystem, right? But Okay, cool. Let's end it there, fellas. This is a good discussion today, man. I like this, right? You know, I'm a big
I
believer
miss
in
what
this
you guys
stuff.
were saying. I miss what you
I
guys
know.
said
Listen,
about the. Sorry,
it was.
got cut out. The internet went out of the office.
It's you can come back. You can listen to it when I post it tomorrow.
Yeah. Well, I have my own thoughts. I mean, I agree that there's a lot of thought. I mean, I think it's probably all the points. I'll listen to it tomorrow.
Yeah. No, listen. Tenders. I really like these tender offers. I actually think they're great, and I think it's great for markets. You know, Nick, to your point, you get like a real good institutional price. Like, it's kind of like, especially like a company. You know, like these companies that do tenders every 6 months. Like, that's great. You know what I mean? Like, you know exactly where that thing's at every single day, and it's nice. So, and there's a lot of management. The one thing I will say, maybe parting thought. Sorry, not to dive back in, but parting thought is that I am seeing folks that do these kind of like managed tenders. They really control the valuation. It's definitely not market value, right? It's super controlled, right? The valuation,
that's what I was
and
gonna
it's
ask.
usually depressed, so they're not going for it, right? It's usually like a lower. It's like it's a lower valuation that's kind of like managed up on like a more linear way.
Revolut though? Like, do you think I was gonna say, do you think a company who's going to do a tender offer should do a certain? There has to be at least a percentage of your market cap offered in the tender. Like maybe it has to be like 5%, because like 500 million.
Well, I would say so. The structured tenders, like so, Evan, I would say it this way. I think there's like tenders, like one-off tenders, and then there's like these like structured tenders. They do it like every 6 months or every year. The folks that are doing it every like a structured tender, I'm seeing that kind of like controlled valuation. The ones that do it every like just a one-off, it's more like a round. So you can just tell they have like a philosophy on the executive team about how they approach like pricing rounds, and they kind of leverage that same approach. Yeah. So Revolut, you can tell, is like they're going for it, right? They're going to get the best valuation they can get. Here we are.
Well, let me ask you this: if you're an RIA,
yeah, go ahead.
Go ahead, Evan.
I was gonna say, if you're an RIA though, and you see Revolut close this $500 million valuation at a $40 billion, are you marking your book up?
I would, if it closes, yes.
Yeah. That's enough of the market cap.
I mean, if you have $500 million traded at a $40 billion valuation, that's the price.
I mean, okay.
I mean, if it was 5 million, probably not, right? But I mean, I think we could all agree $500 million is a lot of money, right? So, and you probably have really thoughtful and sophisticated people coming in to buy that on the other end. It's not like Mr. and Mrs. Smith rolling up $500, $500 million.
I don't know.
Right?
There's a lot of sovereign wealth funds that want to mark up their books and show up, and they're, hey, look, like, you know, you get 5 sovereign wealth funds that throw $100 million into that deal, and now you're able to mark your book up. That seems like a little suspect to me.
But you do have to believe. So to play this out,
these tenders are not.
If you do believe that that's going to happen, you ultimately have to believe, because they're not just going to piss money down the drain, right? So you ultimately have to believe that the company is going to be worth more than $40 billion at some point in the future.
Correct.
Right.
And I think that's the big deal here, because the company is incentivized to price it a little bit low to where their next tender or future exit would be, because then at least it has the employees thinking like, oh, okay, so I sit on $100 of shares today, and do I want to sell all of it because this is the peak, or do I want to sell a quarter of it, knowing that, you know, I'll risk the next 75 to get to the IPO or next tender?
Yeah.
So
look,
well, you're assuming that they allow you to do that.
Most of them. This is where you get prorated, right? So yeah. So if you do a 5 million tender instead of a 50 or million tender or bigger, 500 million, like, yeah, that thing is not going to be oversubscribed.
I appreciate what you're saying. There's like a purity in underwriting. Like, look at the actual fundamentals of the business and like come up with a valuation. And like, that's kind of like, you know, what it is. But I'll just say, like, look, we got crazy numbers in the public markets that companies get booked at, right? And those things trade every day. So like, are you going to come in and say NVIDIA isn't worth what NVIDIA is worth? I mean, talking heads on CNBC and Bloomberg do that every day, right? So like, right. But people are buying and selling the stock at that price. So like, I don't know, maybe I'm like a market guy,
in my opinion.
You know,
I think even
maybe because I've made money.
You know, it's very frothy, and we've demonstrated in the past that
For
Like
sure.
large
But
growth
like,
funds and private funds have done a very bad job of
But
marketing these portfolios.
maybe you just have one shot at it though, right? So
yeah,
the window's open for a day, one day every year. Are you going to pay a forward multiple, or are you going to pay the current multiple?
listen,
It depends
this
what
is
your
what
incentive
makes a
structure
market.
is.
This is what makes a market right here, right?
Just,
So like,
yeah, there you go.
you know what I mean? Like people will be in tears if they buy Revolut at 40 and then, you know, it goes public at 35, they'll be in tears, right? But then if they buy it at 40 and then it goes public and it's at 65, like we all thought Reddit was going to go in the toilet and it ended up trading up, right? And now everybody, that was a great trade, right? So even though like people were like, you're nuts for buying Revolut at 40, I don't know, are you nuts? Like that's what I'm saying. Like the market, like if I knew what was going to happen and if underwriting was always right, I'd be running a hedge fund, right? And I'd be like Steve Cohen. You know what I'm saying? Like I'd be done. I'd own the Canary Islands, Evan. Okay, you know what I'm saying? So like I, you know, like, but I don't like you don't know that. Like, most people don't. So like that's the hard part to me. Like I appreciate. You're right. Okay, like if you look at Revolut from a pure underwriting perspective, it's probably not worth $40 billion. But if people are willing to pay it, I think that's the price. And if you're an RIA and you have that much money trade hands at that price, I think that's the price, you know? So
I don't know. I guess I can give it a long description of how I think that'd fall apart, but it's all depends.
Then you should be buying ApeView, which is pricing it at a discount, and using that to mark your book.
yeah.
Well,
Listen,
maybe.
This is it. This is what literally this discussion is what makes a market. And I think what's so interesting is it's happening now in the pre-IPO space, right? Like there's data, there's some infrastructure now. Like there's data that Nick has, right? There's like data points, there's trades, there's like transparency a little bit into the market. Like we can have these discussions about whether we think it's a fair value or not for the company. It's not like so insiderish where you're like, I have no idea, you know? I have no idea.
The crazy thing is that we have the data, and when you see that dislocation, that's where I get the pause. And when you're looking at $500 million, and I think of all the growth equity funds that are multi-billion dollar or multi-stage funds or crossover funds or institutions or sovereign wealth funds, and I'm sitting there saying, okay, I could put $100 million into a bet that I made at $20 billion today at a $40 billion valuation. Allow me to mark my book up so I can raise my next fund at a $2 billion fund where I get the management fees for 10 years.
Dude, yeah. There were a lot of people, though, to your point, though, there were a lot of people back in 2021 who were like, we're out. We're sitting this year out. Like, to your point, because they were like, this is just way too rich. So, I mean, we could be coming back there. And like, I had this on the agenda, which I ended up pulling, but like SoftBank said they're coming in with $100 billion into AI companies, right? They just announced this past week they're going to start to turn on that faucet. So they were one of the primary drivers, them to go to Tiger, right, of what kind of drove the market up back in 2021. So I wouldn't, we might see something similar happen in AI. And already, I mean, people last year were saying the AI kind of market space was too rich. I mean, we might be kind of going back to that, we might be heading that direction, maybe is the right way of saying it. But listen, man, you're not wrong, Evan. And I appreciate what you're saying. I don't think there is a right answer, but this is what this is the stuff that makes a market. I think what's cool is that we got enough data now to even have a discussion about this. I think 5, 6, 7 years ago, we couldn't even have that discussion,
I guess like as a corollary to where I sit just for our fund and what we manage, it's just like whenever I see, like if I've invested in a Series A company and I see it raise a Series C at a valuation that I believe is aggressive, and if I was an RA, like would I want to market at that valuation? I wonder, just because what's the incentive of the fund? Like, the lead led the Series A, the Series B, and the Series C. So they have all of the incentive. Like, where are the incentives outside of the returns of this specific investment relative to their fund, their AUM? They're raising another fund. The markets have been tough to raise funds. Well, everyone's trying to get a markup on their team, on their. I mean, the DPI is terrible, but everyone's trying to get a markup on. Whatever.
Look, I have strong opinions about So if you're talking about being a GP and where you mark stuff, my only thought would be like, whatever you decide to do, just be consistent across your whole book all the time.
Valuation policy is important. The most important piece of an investment advisor.
Yeah, you don't want to be inconsistent. That'll give you some problems.